David Kelly a moment ago said he expected them to continue cooing. David, this sounds like coup.
It's a deafening amount of cooing. Yes, I think that this is a very, and you know what, it's the right thing to do right now, because what you're trying to do is keep long-term interest rates down. What you're trying to do is help the federal government stimulate the economy and support the economy at as cheap a price as possible in terms of long-term interest rates. The irony in all of this, of course, is I'd be willing to put some money on the other side of them actually keeping rates that low in 2023, because when you get to 2023, if the economy has fully recovered or almost fully recovered, the idea that you're going to be able to keep rates that low with an inflation rate that's already above 2%, I think is unreasonable. And I think what you'll see is long-term rates back up, and the Federal Reserve will gradually have to give in to that. So at some stage, in some way, they're trying to convince the market they're going to be dovish forever. But I think when the economy is recovered, they're going to have to change expectations about where monetary policy is going.
Mona, they've had a hard time getting inflation to where they've ever wanted it, it seems to me. I'd like to put back on that chart of gold and get your reaction to whether an above 2% inflation rate is achievable in an economy like this one. If so, how soon? And what are the implications, if any, for gold?
Yeah, look, I think over the last 5 to even 10-year period, we've only gotten above 2% a handful of times. So inflation generally has remained below the Fed's 2% core PCE target since the last crisis. And as we're going through this crisis, very unlikely that we get close to that 2% range until we reach a more normal level of activity. Now, keep in mind, this lower for longer in an environment where perhaps 2021 we do get a recovery, not only here in the U.S., but globally, could prove to be quite strong for risk assets. So, when you have rates this low and GDP growth potentially plus 5%, earnings growth, thus far estimates are calling for plus 25%. Really, investors could be pushed out the risk spectrum. That's a supportive backdrop for risk assets broadly, including equities. Gold, as you mentioned, really does tend to follow the path of the dollar. So you've seen this inverse relationship hold up nicely. A weaker dollar has led to more supportive gold prices. If that dollar trend continues, we think gold can hold up as well. Generally, we remain favorable on gold, given what central banks globally are doing, keeping rates low, in some cases negative around the world. That's also a good backdrop for gold, but also broadly risk assets. So something to keep in mind as we head to the next 12 to 18 months in particular.